In this chapter, I want to focus on three key aspects of careers that will be most important and valuable for you. So, those three components are the role, the skills required, and lastly, the compensation structure you can expect in each. So, role/career path. All of you who are tuning into this course are from all corners of the world, whether you're in the United States, Canada, the UK, Europe, Asia, the Middle East, Africa, or wherever else you may be. I want this to be relevant to you. So with that said, we're going to focus on the tasks of a career in financial planning or wealth management, and then walk you through a few select global job postings so that we can see together how there may be different titles and conventions based on geography and firm, but that they're very much the same job at heart. Now, skills. As I mentioned previously, you're going to see that there's a lot of similarities across the board, from the services that are offered to the types of education, skill sets, and discipline required to run a successful practice. But what you'll learn in this chapter is that each specific career path has certain skills and traits that, should you really excel in those specific ones, that path would be a particularly good fit. And last but not least, compensation structure. Now, the actual numbers that you take home will heavily depend on what region you live in and what firm you're working for. So what we're going to do instead is we're going to focus on the commonly seen compensation structure that prevails at an industry level. Now, let's get into these roles, and let's start off with financial planning. A financial planner is going to work either for a financial institution like a bank or be an entrepreneur with their own practice. Regardless, the FP is going to be networking, prospecting, and working to convert leads into clients around the clock. With each client, they're going to develop a deep understanding of what the client's financial and lifestyle goals are, what their budget should look like according to the client, and what amount the client should be saving and investing in order to meet the goals that they've expressed. Now, the next part of a financial planner's job is investment management. So in addition to the budgeting and cash flow components, the advisor will have also assessed and documented the client's risk tolerance as well as investment objectives. They are then going to take those two things and recommend an investment strategy that's going to help the client's portfolio to grow to the level that's going to meet their predetermined financial and lifestyle goals without taking on risks that the client is not comfortable with or doesn't understand. The investment mix or portfolio allocation that an advisor will recommend is going to vary substantially from firm to firm and even from advisor to advisor. However, financial planners usually stick to products known as managed solutions, which can include mutual funds, exchange-traded funds ETFs, and separately managed accounts called SMAs. So that is the role of a financial planner. Now let's turn to the skills. And what I want to do is draw out the universal skill set that all financial advisory professionals, so not just financial planners, but all sorts of wealth managers and anybody in this industry is going to need. This is in practice the list that you would get if you were to comb through hundreds of financial advisory job postings of all levels of seniority at all sizes of firms across all different regions. Doesn't matter whether it's a retail portfolio manager, investment advisor, or financial planner. This is a catch-all universal skill set listing for anyone in wealth management or financial planning. So, what do you need to succeed? Well, let's look at the list of skills that I've put together for us. So pause here for a second and take a minute to review the list of these skills. You're going to see them in some way, shape, or form in almost every job description in financial advisory that you come across. Now, in terms of financial planning, the role that we just discussed, I'm going to highlight the skills that are going to be most important for someone being hired into this role. So if you're speaking with and you're interviewing with a hiring manager for this role, these are the key skills that they're really going to look for and make sure that you have demonstrated in the past and really have a passion for. Now, before I share the top 3 skills that successful financial planners excel in, I want you to prepare your own list as well. So take a second to do that. So the top 3 that I have are first, communication and interpersonal skills. a non-negotiable skill that is absolutely essential to succeeding in a role as a financial planner. 2, the ability to handle stress and persevere. And 3, analytical skills for problem solving, whether it is going to be a more academic and financial product related analytical problem, or whether it's going to be a people problem. Those are the top 3 skills that a successful financial planner will always demonstrate. Now, when it comes to analytical skills, this often coincides with what we think of as the knowledge of financial products. For a financial planner, we know and we discuss that they offer a shorter shelf, so to speak. They offer less complex products to their clients just because the types of clients don't require as sophisticated solutions oftentimes. And so financial planners might have less breadth as well as depth of knowledge of certain financial products, but it doesn't mean that they're not as capable as a wealth manager, for example. It just means that there may be less emphasis on this component than if you were a wealth advisor. Now, finally, compensation structure, something that we're all curious about. So how do financial planners earn a living? Well, it's usually from the fees their clients pay for investment management. And in most cases, the total cost of financial planning services is broken down into 2 key components. The first is the account fee, which is usually an annual percentage of the total assets that the client has under management with the advisor. So for example, if a client has $200,000 under management and is paying a 1.25% fee, the total account fee that the client is going to pay per year is $2,500. Now, because the value of a client's portfolio can fluctuate frequently, this account fee is usually prorated daily and charged either monthly or quarterly directly to the primary investment account. This annual fee amount is then going to be split further between the advisor and the firm based on a predetermined ratio. So going back to this example where we calculated $2,500 annual fee, let's suppose that the predetermined ratio is that the firm is going to take 60% while the advisor takes home 40%. This means that of that $2,500, the financial planner is going to take $1,000 per year managing the client's portfolio, assuming that their assets under management, AUM, don't change. The remaining $1,500 will be taken by the firm. The second component of this cost for the client is management fees. Management fees associated with the managed products that the client's portfolio is composed of. So going back to our example, let's suppose that this client's portfolio contains just 2 ETFs, exchange-traded funds, and the portfolio is divided evenly between the 2 of them. The first ETF has a management fee of 0.2%, and the second ETF has a management fee of 0.3%. And so the weighted average of these 2 management fees is 0.25%. This means that in addition to that 1.25% that the client is paying to the financial planning firm, they are paying an additional 0.25% to the fund companies that run these ETFs, meaning that the true total cost is 1.5% or $3,000 per year. And now that I've gone over a numerical example of how fees are calculated, I want you to take a minute to try a calculation of your own just to confirm your understanding of it. If you navigate to the downloadable materials of this course, you'll see a file called Financial Planner Advisory Fee Calculator. I want you to try the exercise out in there. Now, financial planners might also earn fees for successful referrals to other specialists. This is kind of in addition to the fees that they're going to earn from their day-to-day activities. So for example, if a client requires a life insurance policy, which they often do, and the financial planner refers them to an insurance advisor who opens a policy with a client, the FP may be eligible for some sort of commission payment. And it's important to note that FPs usually receive a modest base salary from the firm that they work for, in addition to their portion of the fee revenue that the clients pay. But in these cases, incremental fee revenue earned above a certain threshold is either reduced or capped. And why is that so? Firms do this to ensure that their advisors can earn a comfortable living wage, even while building their book of clients. But firms want to ensure that a certain quality standard of service. So they structure compensation in such a way that prevents advisors from focusing solely on sales and onboarding clients instead of dedicating the time to conducting check-ins and reviews with existing ones and keeping their clients happy. Now, moving on to the career paths that are in wealth management. So there are two key career paths very holistically. On the wealth management side of things, advisors tend to focus, again, on a very different sort of clientele. And generally, wealth management firms are set up to service people with, again, very large amount of assets at the time of onboarding. And usually within wealth, there's going to be two types of advisors who tend to focus on the same types of clients, but can differ in their professional designation, their tenure, and the type of investment management that they provide. And these are known generally as investment advisors or portfolio managers. So let's go over those two individually. We'll start off with the role of investment advisors, aka IAs. An investment advisor is a type of wealth manager who can offer their clients access to an open shelf of investment solutions, which is over and above the standard set of managed solutions that a financial planner has access to. And what this means is that in addition to mutual funds, ETFs, and SMAs, an investment advisor can buy individual fixed income securities like corporate and government bonds, structured notes, term deposits, and individual stocks. They can also run sophisticated derivative strategies and buy hedge funds, private equity funds, and sometimes more. Now, investment advisors can also provide clients with access to primary market new issue activity or fixed income and equity securities that their firm might be involved in underwriting and can offer margin loans and short selling as well. Now, why is this the case? As the old adage goes, more money, more problems. When working with high net worth clients with large portfolios, chances are that they have portfolio risks or gaps in their financial plan that are very challenging and difficult to cover off with standard managed solutions. So these types of risks and gaps can come from several sources. For example, clients may have concentrated risk from multiple real estate investments that need to be hedged. Or maybe those real estate investments are located in multiple different countries, adding various foreign currency risk exposure to the equation. Maybe the client is a retired executive from a large publicly traded company who's accumulated millions of dollars in shares of that company that they're reluctant to sell. Or a young tech entrepreneur who cashed in on their success and now requires professional advice managing multiple holding companies, each with their own investments. Now, given every example I've given, chances are that no two clients in an investment advisor's book of business are the same, and they're going to require a more custom, bespoke, white glove approach to financial advice in order to reach their very diverse goals. Now, similarly to financial planners, investment advisors at wealth management firms are also going to have access to a wide range of specialists who have skills and solutions to meet the needs of this category type of client. So in addition to the standard tax and insurance groups, wealth management firms might also run a number of additional business lines, each with its own specialist to whom clients can be referred. So a common example of this is private banking, where clients can be assigned a dedicated personal banker that they can reach out to directly for retail banking services and advice on things like personal mortgages, business loans, or even simply opening a checkings account or sending a wire without having to go into a regular bank branch. Other such services might include estate planning for individuals who want professional help structuring their will and ensuring that their estate is settled according to their wishes, business succession planning for clients who are business owners and want to ensure that there's business continuity when they sell, leave the company, or pass away, and trust services that can apply to a wide range of situations, from general or family trusts to professional trusts for clients who may be lawyers, real estate brokers, or in similar fields, or even for clients who may need to place particular assets into a trust and hire the firm as a trustee while they're going through litigation. These services are all invaluable complements to the financial planning and investment advice that clients will receive from their wealth management investment advisor. Now let's turn to skills. So going back to that catch-all universal skill set listing that we made for anyone in wealth and financial planning, general financial advisory services, we're going to look at the top 3 for an investment advisor. Now, the top 3 skills that a successful financial planner typically really excels in, those are the ones that are actually going to be the exact same for investment advisors. But where we're going to differ is the professional designations that they might be required to obtain, but this is going to be based on region. Now, the financial planner is going to be, again, offering a shorter, smaller shelf of investment solutions based on the fact that the clientele is a little bit different than the wealth management side. So the wealth advisor, the investment advisor, will need to know a greater breadth and depth of investment products. So they're going to need to lean in to that analytical skill set a little bit more. But overall, the skill set that they're going to need to demonstrate, that entrepreneurial energy, that persistence, and the incredible attention to how you communicate with clients, that is going to be the same. Now let's turn to the second type of wealth management advisor, and that is the portfolio manager. So the criteria for a portfolio manager's license, because you have to have one, can differ between jurisdictions and firms. But usually, investment advisors that we just talked about, who have built up a certain number of years of experience in their role and have reached or exceeded a specific AUM, have met a certain educational threshold, and who do not have any blemishes whatsoever on their professional record, can apply for and obtain a PM, a portfolio manager's license. So what does that mean? The first major difference between an IA and a PM for portfolio manager, is that the PM has a discretionary relationship with their clients. So what does discretion mean? Discretion means that a portfolio manager is given a set of guidelines to follow, and once those are established between client and portfolio manager, the portfolio manager can then place trades in a client's account without first obtaining consent from the client. And this is a key distinction between an investment advisor and a PM. Before buying or selling any security, an IA has to call their client, pitch their idea, and obtain the client's agreement before executing the trade. A PM, however, doesn't need to obtain the pre-trade approval, meaning that they can run a sophisticated, scalable, model-based practice without a ton of one-off client holdings and requests. Once it's up and running, this is what makes a PM's practice very efficient and desirable to most advisors in this field. Now, how does a PM establish discretion over a client's portfolio? Well, it's key to this role. So a PM needs to take an additional step with each of their clients when they're onboarded, which is to draft up, agree upon, and sign something called an investment policy statement, or in short, IPS with that client. An IPS is a legally binding document that lays out the general rules that the PM will follow when managing a client's portfolio. An IPS writing is an art in and of itself, and a typical IPS will include a lot of information and many guidelines that need to be followed by the PM. The standard IPS is going to list all client accounts under management, target asset weights for the portfolio, and strategic limits on each asset class that the portfolio manager could take advantage of based on market conditions. And an IPS may include guidelines about other types of portfolio constraints as well. So there may be a statement referencing, say, a limit on concentrated positions, for example, stating that no single position should make up more than 10% of the portfolio. And similar portfolio limits on things like high-risk positions, like penny stocks, derivatives, or hedge funds, may also very well exist as well. Then there may be certain limits on certain types of companies or sectors in the portfolio, such as a rule that prohibits the purchase of shares belonging to, say, tobacco, gambling, or oil companies. The possibilities are really endless, but it's important to know that sometimes these portfolio constraints are actually client initiated, and sometimes they are in place by the firm as a risk control. So it could be driven by various different stakeholders. Now, if you want to learn more about asset classes and how they're used in a client portfolio, I'm going to point you to the Understanding Asset Classes and Financial Markets course that we have if you haven't taken that already. And IPS writing is covered separately in another course called Portfolio Management for Retail Clients. Now, going back to that catch all skill set that we talked about in our very first discussion on the skills required to be successful in a role in financial planning and wealth management generally. For a PM, the most important skill is going to be the analytical skill. The PM has a discretionary relationship with the client, and it's going to take someone that has a real knack for markets, a real passion for them, and someone that doesn't mind but rather enjoys being knee deep in spreadsheets, doing lots of research, lots of technical analysis, and always keeping up with markets. So not only are they exceptional in their communication skills, can go out and get clients and whatnot, but they're super technical, and these people tend to be the most technically advanced and most passionate about markets amongst the three roles that we've talked about today. And now let's turn to the compensation structure for IAs. So on the account setup and compensation side, things work a little differently at wealth management firms than they do at financial planning firms. So oftentimes, investment advisors have the option of setting up their clients with commission-based accounts or fee-based accounts. In a commission-based account, IAs don't charge their clients a monthly service fee, but instead charge a commission per trade, which is either a flat amount or is a percentage of the notional size of the trade. So for fixed income or foreign exchange trades, these are called spreads. In commission-based accounts that contain mutual funds, those mutual funds often pay something called a trailer, which is a monthly commission fee that the client pays as part of their mutual fund management costs that go directly to the advisor. Now, historically, commission-based accounts were the only type of account available at wealth management firms, but in recent years, fee-based accounts have become much more popular, and they are the preferred way by firms to charge for investment advice. Now, that said, there are a few reasons why a client might prefer to have a commission-based account. So for example, let's say that you have a client who has a large, concentrated position in a blue chip stock that they never intend to sell. They're content having that stock sit in an account, paying them dividends in perpetuity. In this circumstance, the client would be much better off with a commission-based account, so they're not paying investment fees on a position that they require no advice on. Similarly, clients who do an extremely low volume of trading, like those with fixed income portfolios and individual bonds, might make a trade less than once a year. For them, the most economical way to invest is a commission-based account. The fee-based account that investment advisors offer are very similar to the model we discussed for financial planners. Essentially, clients pay a fee that's based on the total size of the assets that they have in their portfolio. But why are fee-based accounts the preferred way to do business in the industry? Well, for starters, it properly aligns incentives between the client and the advisor. So in a commission-based account, the advisor earns more when the client trades more. And historically, this has led to something called churning, which is when an advisor recommends investments to clients, not because it's in their best interest, but because it will generate more commission revenue for the advisor's pocket. This is an extremely unethical practice that's become grounds for dismissal at most firms today. Now, with fee-based accounts, because fees are based on the size of the portfolio, advisors have an incentive to help clients grow their money. So if clients are making money, they're happy, and advisors are rewarded for doing a job well done. This helps build the foundation for a long-term, mutually beneficial relationship. While financial planners are paid a salary from the firm that they work for, things are a bit different in wealth management firms. They tend to have a much more, quote, sink or swim type of culture. So usually investment advisors are only paid a salary for the first year or two of their careers, which is treated as a sort of probationary period. This is mainly to give the advisor the means to live off while they're building their book of business. And after that probationary period has passed, the advisory salary is removed and they switch to a fully commission-based compensation structure. Now, the idea here is that the firm assigns an assets under management, or AUM, target to the advisor during their probationary period. And let's hypothetically say that the target AUM is $50 million, and the probationary period is for 2 years. If after 2 years, the advisor has not built their book to that size, they may realistically be asked to leave the role or the firm altogether. However, if they have succeeded and they're successful in their pursuit and have acquired $50 million of client assets under management or more, they have already built a book that's large enough to generate a very comfortable living for themselves, and it sets the stage for them to continue growing their business. Now, unlike financial planning firms, wealth management firms don't cap the upside earnings potential of their advisors. In fact, as an advisor's book grows, the split of fee revenue between firm and advisor becomes more and more favorable to the advisor as the advisor moves up in what is known as the quote-unquote grid. So let's look at an example together. So let's suppose a junior investment advisor is in the 3rd year of her career, which means that she's 1 year out of probation, because we called the probation period 2 years. Her book size is $80 million, and because her book size is on the smaller end of the overall scale, she's going to have a lower position on the grid to start off with, which means that for every dollar in fee or commission revenue that she generates, she gets to keep 30% while the firm keeps 70%. But she's recently onboarded a client with a $1 million portfolio in a fee-based account who's paying 1%. This means the client is paying $10,000 a year in fees, $3,000 of which is going to go to the advisor, and $7,000 of which is going to the firm. The same split applies to all of the revenue generated by this advisor's book currently. Now, let's say that we're looking at the same advisor, but 3 years down the line. And at this point, she's become very successful at acquiring new clients and has grown her book of business to $300 million, which has moved her up several places in the grid. Now, for every dollar of revenue that she generates, she gets to keep as the advisor 45%, while the firm keeps 55%. For that same client with a $1 million portfolio, this advisor gets to keep $4,500 per year, as opposed to only $3,000 now. And now this is all because the changes to the grid affect the advisor's entire book. So she now has significantly improved her take-home compensation.